The futures prop firm space is constantly evolving. This week, TickTickTrader retroactively changed the rules on their straight to funded accounts, and traders are frustrated. In today's video, I'm going to break down all of these rule changes, how they affect traders, and more importantly, why retroactive rule changes by prop firms are a huge problem. Let's dive right into it. So for those who don't know, TickTickTrader is a prop firm that offers straight to funded accounts. Straight to funded is a shortcut, instant funding. There's no eval phase, there's no long evaluation process. You basically pay, you trade, you meet the rules, and boom, you get paid. At least that's what you thought. And here's where things get messy. TickTickTrader retroactively changed the rules on their traders after they had already signed up for an account. This is the email that traders received from TickTickTrader about the new rule changes. So, dear TickTickTrader community, we are writing to inform you about important updates that will take effect starting Sunday, March 23rd, 2025 at 9 p.m. UTC. We have observed significant prohibited trading activity such as hedging in clusters, which has cost the firm hundreds of thousands of dollars in undeserved payouts. In response, we are implementing the following updates. So according to this, they have a problem with hedging. And because of that hedging, the firm has paid hundreds of thousands of dollars in undeserved payouts. The problem right off the bat is it's the typical rule change update, blaming the traders, right? It's always the schemers, the scammers, blaming the traders, something the traders did, and because of that, rule changes are in effect. Updated drawdown limits. We are introducing the following drawdown limits for direct accounts. 100K, 4,000. 150K, 6,000. And the 250K, 9,000. So it's a reduction in the drawdown on these accounts. So if we take a look at, for instance, the 100K is now 4,000 on their website. Right now, the 100K has 5,000 in max loss limit, total drawdown. The 150K is now 6,000. That's a drop from 7,500. And the 250K is now 9,000, dropped all the way down from 12,500 in drawdown. So it's a huge change. Now, the drawdown limit for the 50K base direct account remains unchanged. The daily loss limit also remains unchanged. Now, to be fair, this rule right here was not retroactive, meaning, and I'll read it, any direct account purchased before March 23rd, 2025 will retain the old drawdown limit as long as the account remains active. So that's fair. Listen, every prop firm, I've said this in multiple videos, has changed the rules, will change the rules at some point, period. It's the way prop firms evolve. This is the right way to do it, at least the first part, right? If you buy a new account after March 23rd, these are the new rules. It's your decision. If you bought the account prior to March 23rd, you still keep the same drawdown rules per the agreement that you signed and based on what you saw on the website, right? So in other words, if your account was purchased before March 23rd, you still have this end of day drawdown. In other words, the higher drawdown, 5,000, 7,500, and 12,500 for the 100, the 150K, and the 250K, respectively. So in that sense, that's fair game. TickTickTrader did the right thing. They announced the rule, gave you guys a couple of days to decide whether you want to purchase new accounts. However, if you purchase a new account, these are the new drawdown rules. And listen, you can't complain. Prop firms have to keep themselves sustainable, right? They're going to make rule changes. The more payouts, I've said this over and over on multiple videos, as the number or the percentage of profitable traders increases within a prop firm and the payouts are increased, they have to adjust the rules. It's the only way they can sustain themselves, and they have a right to. However, the second part is where TickTickTrader applied the retroactive rules, meaning if a trader purchased an account and they purchased it with the understanding of certain rules, well, that has now changed when it comes to the safety threshold or taking a payout without a buffer. And I'll explain. Starting March 24, 2025, withdrawals must be made from profits exceeding the safety threshold or for direct accounts. Withdrawals from within the safety threshold will no longer be allowed. So, for example, if you have a 150K direct account, you must reach and maintain a balance of 157,500, and you may only withdraw profits beyond this amount. Payouts submitted before March 23rd are exempt from this update and can still be made from within the safety threshold. So in other words, whether you bought the account prior to March 23rd or after, the withdrawal from the safety net or the threshold has changed. Basically, let's go back to the original website. So on the 150K, your profit goal is 7,500. In the past or currently, if I get to 7,500 in profit on a 150K, I can withdraw 3,000, leaving $4,500 in profit in that account. And that's what I've done. I have the 150Ks. I get to 7,500. I request a payout for 3,000, and I'm left with a balance of 4,500. Now, the new rule for new accounts and old accounts, it is a retroactive rule even for old accounts. You must meet the 7,500, but you got to maintain it after the payout. So if I want to remove 3,000, I no longer have a profit goal of 7,500. My profit goal now is 10,500 to remove or to request a payout for 3,000. That's a huge change. And again, prop firms have the right to change the rules at any time. It's how this industry works. It's how their agreements work. The problem is the retroactive part of this. Why? Because let's say last week I purchased a 150K account and I read the website, and this is the reason I made that decision. I like the rules. I like the daily loss limit. I like the end of the day drawdown. I like the ability to take out 3,000 or reach a 3,000 profit goal on the second payout and withdraw from safety net. Yes, in other words, I did not have a payout buffer. Well, this is the reason I made that decision as a trader, right? I purchased the account because of what I saw on the website. Well, they retroactively changed the rules, and that's a huge problem. That's where prop firms, start getting themselves into issues, and this is why it's a red flag. It's a breach of trust. A trader purchased the account with certain guidelines, certain criteria on their website with that understanding. When you change those rules, when you rug pull them, when you change the rules retroactively, you are breaching the trust and questions come up. And that's why I have to raise a red flag in this case. Prop firms have every right to change the rules. This is not what this is about. The problem is the retroactive changing of rules. Other prop firms have changed the rules, but they differentiate between new and old accounts. New accounts will have these new rules, old accounts have their old rules in effect. And that's fine. But when you change a contract, an agreement, right? I purchased an account based on an agreement that's changed on me and I can't say anything. The trust is broken. And I have to raise the red flag. We went through this with fast track trading a couple months ago, the rug pull, the retroactive rule changes. And at the time, I made a huge mistake. I actually trusted or I believed in their CEO and thought at the time that those retroactive rule changes were fair based on the circumstances that FTT was going through. Time has changed, people have evolved, traders have evolved, I've evolved. As traders, we can't allow prop firms to think that changing the rules retroactively is right. There are prop firms out there like Tradeify and other prop firms that have changed the rules, but they did not apply retroactive rules. They have done it the right way. They've sent an email similar to this with all the new rule changes. Any account ordered or purchased after this date, new rules in effect. Any account Purchase prior to this date, old rules remain in effect. That's the right way to do it. We went through this in the past with fast track trading and other prop firms, and it's simply not right. And as traders, we can't allow it to be right. So I hope TickTickTrader listens to their traders. After they announced the rules, their own Discord traders were expressing their frustration. And rightfully so. Nobody likes to get retroactive rules applied on them. Let's continue with the email. The virtual live arcade reward. After the first 2 months of virtual live arcade, we have decided to introduce an additional incentive for both risk managers and live traders. To support this, we are adjusting the profit split for the sim phase, that's sim evals and sim funded or direct funded accounts, creating a shared pool for live traders and risk managers. The sim phase profit split will change to 80-20 instead of the previous 90-10. Payouts for the sim phase submitted before March 23rd, 2025 will benefit from the 90-10 profit split. So again, if you had signed up for TickTickTrader with the understanding that your profits or your payouts were 90-10, you got rug pulled. The rules are retroactively changed as well. They'll honor the existing rules until March 23rd on new or old. But even if you have an old account, after March 23rd, it becomes an 80-20 split. So for instance, going back to my example on the TickTickTrader 150K, if I get if I request a $3,000 payout like I've done and I've made videos, I don't get the full 3,000. But I knew that when I signed up for TickTickTrader account, it was a 90-10 split, so I would get $2,700 deposited into my Rise account. Now, whether it's a new or, in my case, and other traders' old accounts, it's no longer a 90-10, it's an 80-10 split. So $3,000 payout now becomes $2,400. So basically now on a 150K, not only do I have to make, to get the 3,000, 10,500 in profit now, not 7,500. When I do get to 10,500, I don't get 2,700. I get a $2,400 payout with the new 80-20 split. Big changes. At the end of the day, like I've said, prop firms have the right to change the rules. Retroactive rule changers are simply wrong. The trader is going to have to make some decisions and probably look at other prop firms that offer straight to funded, or simply not consider TickTickTrader for straight to funded and maybe more for their eval or challenge phase accounts. So how do these rules affect traders? Well, let's take a look at that 150K. Let's say I have an account, or a trader has an account, and they're at $5,000 in profit right now on a 150K. They're calculating that by Monday or Tuesday after March 23rd, they'll get to the 7,500 profit goal. Well, sorry, buddy. Now you got to get to 10,500 to get that $3,000 payout, which after the 80-20 split, it's now 2,400, not 2,700. So if you thought you were close, or if a trader thought they were close to a payout, it's now been extended. And like I said, we know this, prop firms will change the rules, but the issue that traders are going to have and the traders are going to have to review is the retroactive application of these rule changes. And listen, at the end of the day, this isn't about TickTickTrader. This is about accountability in the prop firm industry. We can't simply let prop firms get away or think that it's right to retroactively change the rules on their traders. It sets a very dangerous precedent. So what do you think? Is this a deal breaker for you? Have you been affected by these rule changes? Let me know what you think in the comments. And if you found this video helpful, do me a favor, smash that like, smash that subscribe button, and more importantly, hit that notification bell so that you get notified